Now, off to a late start here. I my little Poker 3 60% keyboard works perfectly until you need to use the tabs on it, and so it wasn't enabling me to switch back and forth between what I want to show you and my picture of my face here. The reason that I decided to stream this tonight is because if you're in both Econ 53 and 136, I want you to see if you can find a way to look at the opening of the markets tomorrow, because what you're going to see is likely to be historic if the behavior of the options market tonight, not the options market, the futures market tonight, is any indicator of the open. So let me describe to you somewhat systematically what's going on here. Okay, right here we're looking at the CME Group website. And so as we scroll down that site, take a look at this right here. This is the E-mini Dow futures. Now this has come back a little bit from what it was about 20 minutes ago. 20 minutes ago it was down 1,340. Right now it's down 1,025, but still that's a huge drop if that holds. Now sometimes when this happens, the market will get closer to reality in the morning, and it won't open down this much, but other times it'll open down even more. And you can see that's in excess of 4%. That would probably, in percentage terms, not be a record low open, but it might be, I'm not sure. It would certainly be in points terms, the largest as measured by the Dow. And as you can see, when you look at the S&P 500, they're down even more. And actually the E-mini and Russell is down even more. But that isn't even the shocking news. What I've been trying to do some background research on this event over the weekend, because I'm trying to gather information. I'm trying to get my machines to gather information, especially to track volatility because it's at record levels. I've also been corresponding with people. I had a big exchange on Reddit with one guy about the bizarre behavior of the VIX at the market close on Friday, and people discussing exactly what happened, because that was also a bit unprecedented. And when I look at this, this is more than a market decline. This is an across-the-board fundamental collapse, because many times, the stock market will have a tough time like it did in 2008 when the mortgage crisis was kicking in. But for a while there, only the stock market went down. The stock market is actually healthier right now, even though it's going to open down more than 1,000 points tomorrow, probably, than many of the other markets. What is even more shocking than the stock market is oil. Now, this is absolutely unprecedented. This has never happened before. You probably know that crude oil is usually between $50 and $60 a gallon. You also may know that since this stuff started happening, that crude oil has been coming down. But the futures market has it tomorrow opening at $32.92. That's not a record low. I checked many years ago. It dropped down to 27, but that's at a time when the prices were a little bit lower. And this, though, is an $8 drop. It's a 20% move. And given the calculations I've made on the volatility of crude oil, that is a 10 sigma move for one day. And this is partly because of the OPEC breakdown that happened on Saturday. OPEC was going to try to control production to boost the price of oil back up. That didn't work out. But then, of course, this is absolutely across the board. It's not just oil. You go over to natural gas, where my pointer is right there. I hope you can see this pointer. I'm not sure that you can, actually. Yeah, I think you can see this pointer probably. And so Henry Hub natural gas, in case you can't see it, in case you can't see this pointer that I'm looking at. Sometimes it doesn't pick up on the video. It's under energy, and on the top, it's on the right side where it says Henry Hub natural gas futures, $1.64. Well, that's a significant low price. The typical price of natural gas is between $3 and $4 an MMBTU, and this is $1.64. That is not a record low, but it is heading in that direction. Gasoline also has had a 16% drop and the like. And then, of course, gold is, of course, soaring, not as much going up as everything else is going down, but gold, of course, is rising. And I'm glad to see that because I have some gold. So, and then you can kind of see from the red that across the board, many of the agricultural commodities are going down. But the real news in here is crude oil, natural gas, and the stock market as a whole. So at a minimum, try to, in the morning at market open at 6:30 our time, and now we're on daylight savings time, try to maybe take a look at the open just on the internet. Some of you in Econ 136, of course, have brokerage accounts, so try to look at it from the perspective of your brokerage account. And let's see if this holds. The market behavior on Friday was really strange. Now, of course, this is tied somewhat to the coronavirus, and this is the link I sent you for the page that I wanted you to look at. This, of course, shows that the level of confirmed cases is rising, although it is tapering off in mainland China. The alarming growth today was in Italy. I think yesterday Italy had only 4,000, and today it has 7,000. And in the United States, of course, we don't know, because probably the least competent response to the coronavirus of all the countries in the world, except maybe, let's see, Algeria has it, so maybe they're not doing as well as we are. And let's see, Nigeria has at least 5 cases, so maybe they're not responding as well. But the least competent response of any advanced country in the world is, of course, the United States. Just bozo level response to this. As of yesterday, they had conducted a total of 1,193 coronavirus tests nationally. And despite all of this talk about maybe we'll have a few million tests next week or the week after or something like that, we don't have the lab capacity to process anywhere near that level of testing. There's been a complete breakdown. Of course, the Center for Disease Control had its funding cut, of course, at the beginning of the Trump administration. It's just a shell of itself and is barely able to function. So we have 547 cases, but we don't have the slightest idea of how many we actually have because nobody's really being tested yet. That should clarify, I guess, this week. But anyway, it's also, of course, what concerns people is the implied mortality rate from this. Now, the deaths divided into the total confirmed, which I think I calculated comes out to 3.4%, is not what people normally think of as the mortality rate for the flu. What this would be is the mortality rate of those who have been confirmed or tested and confirmed. And that, of course, is going to be much higher than the mortality rate for those who have the virus. But I've seen credible estimates coming, in fact, from Johns Hopkins that say even if you make that adjustment, it's likely to be about 2%. And, of course, the influenza rate is 0.1%. And so, of course, it's 20 times higher or 30 times higher or something like that. And that's the real concern. It's also the case that your age group isn't much affected by it. There are some deaths, but not very many. It's, of course, most of my age group that's being affected by it. But it's way more serious than the flu because of its high mortality rate. And of course, there is a possibility that it will substantially spread unless steps are taken to contain that. It looks like the steps taken in China to contain it have worked, because down here on the bottom right of the graph, we can see that that's tapering off if the data coming from China is accurate, and it probably is. I don't think we could take methods that extreme. As you know, though, it may mean that Harvey Mudd College will have to close for this week. I guess that has not been decided yet, or it has been decided and we're not going to do it. Or we may extend spring break because, of course, Stanford has been closed. University of Washington's been closed. I heard that UCLA is closing. That's just a rumor, though, so I'm not sure that that's true. USC is considering closing. So I'll talk a little bit about what that might mean for you if it happens at the very end of this. The coronavirus is, of course, the trigger that set all of this wild financial reaction off. But this is not entirely due to the coronavirus. The coronavirus just triggered it off. we're actually looking at some underlying structural flaws in this economy that are really coming home to roost now that we've had this erosion. If you think of the coronavirus economic impact, say upon earnings, which is what the stock market responds to, it's not likely to be all that much. There may be a bad quarter or two bad quarters, which would, of course, be by the definition a recession because there's been such terrible interruptions to the supply chain. But we would recover after that, I would tend to think, unless this coronavirus takes a turn for the worst. I don't think very many people are expecting that to happen. It will, of course, have many, many more cases in the United States, and there will be some consequences to that. But and that's tragic, but by May or June, this is likely to be gone, and some of the demand that was lost will simply be replaced then. For example, if you're not going to auto dealers right now to buy a car because you don't want to go out in public, you can go buy a car in May or June. There will, of course, be substantial, terrible losses in the hospitality business, restaurants, hotels, because, of course, if you skip 3 weeks going to a restaurant, you don't make up for that 4 weeks later. You just resume going to the restaurant, but you don't replace the 16 meals you never bought. And the cruise line industry is probably completely dead, as the airlines and the like. There's also, of course, at a more serious level, supply problems on infrastructure. Basically, American corporations run with relatively low inventory, and of course there has been a substantial interruption to supply to that inventory. And so that is going to impact corporate earnings for at least 1 or 2 quarters, and the market should be going down in response to that. But why would oil go down in response to that? And why would interest rates, which I have yet to describe, respond in the way that they have? I'm looking here right now, curious about what Bitcoin is doing. Bitcoin seems to be unaffected by this. It rises and falls. No, maybe not. No, Bitcoin's down 8%, although an 8% swing in Bitcoin's not unusual. It's coming off of a high of close to $10,000 a couple of weeks ago. But Bitcoin, nonetheless, even though this is down 8% here, Ethereum's down 13%. Oh, yeah, maybe this is. Bitcoin SV is down 35%. No, 15% down $35. Yeah, that's actually a pretty big drop. So maybe Bitcoin is responding to this as well. We go to the Wall Street Journal and let's see if they're getting hysterical. This is their headline tonight. Yeah, no, not really. Yeah, well, they are saying here, though, companies that got caught out of China before the virus. Oops, actually, you're looking at my face. I think, no, you're looking at. Oh, that's good. You're actually looking at this. Okay. Companies that got out of China before the virus are still tangled in the supply chains, and then crude prices stink 20% as Saudis and Russia clash. I didn't know about the Russia part in that. That's new. And there's not much else so far in the Wall Street Journal, although that'll be different tomorrow morning. I wanted to show you interest rates, and instead of showing you that on the newspaper, let's take a look at them here. So I'm not going to blow this up. Okay, so in Econ 53, I showed you these first 2 slides to show you what the yield curve of U.S. Treasury rates typically looks like. And so 2004, you can see the 3-month rate begins at 3%, and the 30-year rate is at 6%. 2005, the Federal Reserve System was raising interest rates because they were concerned about mortgage speculation. So the reason I had this graph in the 2005 lecture was showing you that they were effectively raising rates to try to slow the economy down. Now, that didn't last very long, of course, because they had to reverse this in 2007. Now, in class, I showed you this graph on February the 20th, where we were comparing last year, which was 29 April 2019, to the same day comparison, February 20th, 2020. And remember, I described them both as flat, and that's unusual because it doesn't reflect the risk structure that's built in. They're not perfectly flat. They do rise up a little bit toward the end. But I was commenting that interest rates are coming down across the board, and that look at how far they had dropped, nearly 80 basis points in 1 year, and the 30-year fixed at the very end was at 2%, which is way below its historical average. Well, let's take a look at Friday compared to these two. So the top two, the graph looks a little different, but the top two are the same ones I showed you. The very top one is the 2019 graph. The middle one that's kind of reddish is the 2020 graph. And the one on the bottom is Friday. And you have to realize that the difference between 20 February and 8 March is about 2 weeks. So that's where we are on Friday. And I guarantee you tomorrow at the market open, they're going to be way below this. And so there'll be probably across the board a 25 basis point drop on everything. And so we're going to be basically sitting on the abscissa. Now, the 30-year rate is just a little above, the 20 and 30-year rate are still above 1, but not much. The 30-year rate is 1.25. The 10-year rate, which in 2019 was 2.5, and at one point hit 3, is now at 0.8. And as you can see, these down here are sagging down to levels like 0.25 or so. And tomorrow, these are going to all drop by my estimate, 25 basis points. Now, the way you can track this if you're an Econ 136, the way you can see indirectly what's happening here is by tracking tilt. Remember, I commented that tilt's at 158. That is absurd. That's just a ridiculous price for tilt. And tilt will probably go well above 160 tomorrow. So I should have actually made a slide writing this down. Let me write this on a slide for you. Okay, the VIX. Oh, this VIX. Tilt. Junk. SPY. And DIA. Okay, so that's what you want to perhaps try to look at tomorrow. Now the VIX, the VIX is just crazy right now. The VIX went up to a record level, not a recent record level. It's getting pretty close to its all-time record now, which I think is 70, between 70 and 80. And it got up close to 60 on Friday. And then at the very last 40 half hour really of the market, there was this huge rally in the Dow, a 700-point rally, a rally in SPY or the S&P 500, and a collapse of the VIX down to about 48 or so. So what I was writing people about and kind of debating about over the weekend is what caused that. And most of the explanations I saw of that were complete nonsense. If you hear this rumor that somebody by himself on the floor of the Chicago Board of Exchange was trying to do VIX futures, and he was playing such huge contracts that he pushed the index up, and then he got a margin call and everything collapsed. That's kind of like going around the internet right now. That's complete bullshit, because the VIX index is determined by the spreads on calls and puts on SPX, or the S&P 500, not anything else. And so if the VIX index is going up, it's because calls and puts are getting really, really, really expensive, as we've said in class about 100 times, right? It's also the case that my tracker in the office has been tracking SPY's implied volatility. As I said in an email that I sent to you Friday, SPY's implied volatility at the last track it did, which was on Thursday. Didn't go into the office on Friday, or maybe even Wednesday. At any rate, it was not Friday. It was before Friday. It was 3 sigma. 2.969 sigma is what it was. And that means that on Friday that it went to about 3.5 sigma. You say 3 sigma compared to what? Compared to the 252-day moving average that existed up until about a week before all this happened. So in other words, compared to the trailing stable market for 1 year. And it isn't all that different. The 30-day had risen by then because of the recent market. So the 30-day wasn't comparable. So I was looking at the stable period. So it's running at 3 sigma, went to 3.5 sigma or so before then. But I pointed out to people that VIX collapse we saw on Friday was nothing more than a move from 3 sigma to 2.8 sigma. And it's entirely explainable simply as a phenomenon that it can be explained by repositioning. The options market, I was trying to capture a video, but this little laptop I've got can't do it. I have to do it in my office. Of the limit order book for options on SPY, it was just screaming. You could barely read it. It was going so fast. But there were not very many trades being made. It was a standard high-speed algo stuff, putting bids out and pulling them back, putting them out, pulling them back so fast you couldn't even figure out what was going on. The interest rate issues where I wanted to go back to. So let's go back to this. I don't know. Yeah, okay. And let's go back to this. All right, this. Okay, now this means that you've heard my complaints about the Federal Reserve System. First of all, you may be saying to yourself, well, these interest rates are coming down because last week the Federal Reserve System, probably Wednesday or Thursday, I forget which day, in a big policy announcement, dropped the federal funds trading rate by 50 basis points. I guess this happened on maybe Monday or Tuesday, actually, because I remember remarking to Econ 136, that's irrelevant, they're incompetent, they're out of the game, they're not participating anymore, the Federal Reserve is done. They basically have spent all their ammunition, they're out of ammunition, they have to sit on the sidelines and watch this economy go wherever it's going to go. Because these interest rates have been systematically declining, including long before they cut that rate officially. This is just a continuation of the trend that you're looking at right here. That decline from 20 February to 8 March started on 20 February, or didn't start on 20 February, it continued. They've been systematically coming down, and they were coming down and were very low long before the announced federal funds rate cut, and they're coming down tomorrow, and it has nothing to do with Federal Reserve policy. It's determined by the market. There's this massive flight to quality going on in these markets. This is why tomorrow I want you to look at J and K, because the other problem that I'm worried about, is the liquidity of these below investment grade bonds. I've been saying for about 3 years these are not liquid assets. I've been saying if there's a crisis, there's going to be all hell to pay for being invested in these. These are going to go to Lehman Brothers prices in a bad downturn. And I don't know if in this case they're going to go to Lehman Brothers prices, but they very well might. It's very clear in these markets that liquidity has dried up. It is very difficult to sell these bonds. And I pointed out in my chapter on ETFs and in my lectures on ETFs, actually for the last 3 years or so, that all of those ETFs like junk are endangered by their incapacity to get rid of their inventory if there's a collapse in demand for their product. Remember, they issue through these subscription units. They're supposed to draw back when these subscription units are no longer wanted by the public. They can't do that unless they can liquidate their inventory. And these markets are becoming so illiquid, there's no way to easily do that without doing it at severe price discounts. So we saw a flurry of that problem that was remarked upon by the Wall Street Journal on Thursday and Friday, just general liquidity. And so everything's going into treasuries. And this is why the treasury rates are coming down. This is an extreme flight to quality. Okay, so watch the market open tomorrow. This is way past the effect of the coronavirus now. Let's see what the yield-bearing markets are. You'll notice that the news, they don't even begin to talk about the bond markets. The stock market goes up and down, and even a 1,000-point drop. You know, this sort of thing has happened before. There's eventually a rally. The bond market is the issue, not the stock market. And to some extent, the oil market is the issue, or at least as much as the stock market, as important as the stock market, and far more indicative that we're looking at potentially a really wide structural problem. And again, the Federal Reserve, in their absolutely bumbling incompetence, have no real capacity to contribute to policy as they've traditionally done in the past. Because as you know, what they do is they provide liquidity to the system, and that drops interest rates a lot. They can't drop interest rates a lot. They're on the abscissa right now. They can do one thing, though, and they might, if this really becomes bad, they still can acquire bad assets from banks. and they can, pick up $3 or $4 trillion worth, just like they did the last time that happened. But if those bad assets, the excess reserves essentially, if those get to $5, $6, or $7 trillion, probably central banking as an institution will lose all legitimacy in the modern era. And so that would be a stopgap measure at best, and that would be very dangerous. I am going to continue to be posting videos. I was diverted a little bit by equipment problems I've been trying to solve. And I'm not coming in this week, as I've already said. I think there's a real threat with this coronavirus, because with no testing going on, we don't know who has it, and college campuses are vulnerable to it. I hope that you've been well informed about what the options are being considered. I assume you have been. The faculty have been. There wasn't any information that I saw, at least in email, that came out over the weekend to the faculty. So if you're wondering why you haven't heard anything, if that's the case, then nobody has. But tomorrow morning, I would hope, you may get a kind of a status report or an update on what the college is doing. I think we have to respond to what we think we should do, given that Stanford is shutting down and the like. The infection rate seems to be higher, by the way, in Northern California than it is down here, and so maybe the decision will be made to keep people through the week. Some of you may be decided, to hell with it, I'm just going to go. I will be posting up my lectures all the way through at a pace more or less consistent with what I would have done if we were still meeting class. So I want you to stay plugged into what I'm doing, please. And I'm trying to actually contribute to the education you paid for up until the time you graduate if you're a senior. I realize it's all mixed up and your heart's not really in it and you're kind of worried about things. And so we're going to, dial it back quite a bit in terms of what I expect out of you, especially on grading efforts. I realize that if you're from overseas, and especially if you're from China, you're probably really wondering what you're going to be able to do. And I guess my guess is that they'll ask you to stay on campus and kind of ride this out. You obviously couldn't go to China if you wanted to right now. There are no flights to China that I know of. And you probably wouldn't want to, because then you would have trouble coming back. So if you have friends here who have to stay on campus, be supportive of them, because that's a hell of a thing to have to do for spring break. I guess you can take off and have a spring break, but once again, that's a little more dangerous than it typically is. So make sure that you are being informed on what's going on. Now, the Dean of Students Office and the Dean of Faculty, all the faculty are definitely trying to figure out a way to make this as acceptable as possible, or to minimize the trouble and the inconvenience, and certainly to minimize the danger. We're looking for guidance from others because, of course, this is really unprecedented. And we're not getting guidance, of course, from a national level in the United States. It's completely incompetent, just absolutely incapacitated at the top level. I mean, Trump was playing golf at Mar-a-Lago today, and so far he thinks that this will just go away. So, and that's reflected in pretty much everything else that's going on. CDC is unable to do nothing. So you'll be hearing from me in the form of videos and the like, but watch the market open and